right, I think we're getting close to having everyone join us that is planning on joining us. I'm going to go ahead and get started. My name is Sipra Boyd. I'm one of the shareholders at Roberts Markel Weinberg Butler Haley. I am a shareholder in the POA section. Happy to be here, and thank you to all of you for joining our seminar today. We're going to talk about the impact of unaffordable or unavailable insurance for condominium and townhome community associations. Again, my name is Sipra. I am board certified in residential real estate as well as property owners association law. Just a quick disclaimer, the information that's presented today is based on the law as it exists today, January 23rd of 2024. Certainly the material is for educational purposes only. So if you have a question that is really specific to your particular association, we're going to recommend that you contact the association's legal counsel to ask about that question, because certainly each fact will matter when it comes to providing a legal opinion about the particular topic. All right, for the agenda today, we're going to talk about just generally condominium and townhome community associations, what has caused and some of the consequences of the insurance rate increases that we're seeing, and then subsequently what the ramifications of those rate increases are on our community associations that we serve on the boards for and manage and represent. So, and then we're going to finish it off with a forecast that doesn't look great for us of those that work with these types of community associations. But, again, it's better to be prepared and know what's coming. So let's kick it off. I'm going to go ahead and try to get through the presentation entirely. It should be about maybe 30, 45 minutes or 40 minutes. And then if you have a question, feel free to raise your hand, or if you want to put it in the chat function, I can go through at the end and I'll go through and answer those questions through the chat function as well. All right, so the idea for this kind of came to me in 2022 when we were seeing just the beginnings of all of these steep increases in insurance premiums. We were just all getting out of the pandemic, and I'm not sure everybody knew which way was up, but certainly we had a lot of our community associations that we represent coming to us and saying, hey, what's going on and how do we deal with these issues? Either by virtue of what you could charge in terms of your assessment, or how high you could raise your assessment, or just general limitations on what associations thought their homeowners could and couldn't afford in paying their assessments. Again, the associations that we manage or represent were coming to us and wondering, how to deal with this, because obviously insurance or providing insurance is a big part of managing associations and being in a deed restricted community. So we were forced to come up with different alternatives to try and consider and to offer as solutions to our community associations. I am going to choose or use the words community association, POA, HOA kind of interchangeably, but I want everyone on this call to understand, this webinar to understand, that this presentation is focused on townhome associations. So those are single family associations, but just in the townhome realm. And we'll get into a little bit about the differences between those and condominium associations. So just those two forms of ownership. Now, certainly everybody that is involved in community associations, whether it be condominium, typical single family, or townhome, understand that the assessments, kind of the collection of the assessments, create the basis for the rights and the responsibilities of the association and what the association is required to provide based on the funding that it receives. Those then, the assessments are deposited into a maintenance fund of some type, which is used to pay the association's operating expenses, which typically include the insurance premiums that are paid to cover the association for various types of insurance policies. Also, part of that assessment fund collection might be used to take a portion to put into reserves for saving for later types of maintenance issues for their either their amenities or their reserves, their green spaces, those types of reserves. But the operating expenses are mainly where the funds for paying these insurance premiums come from. And so, depending on the type of association that we're talking about, the insurance policies are required to protect different or a variety of areas for that community association. If you're in a condominium association, the association is required to also required to insure the common elements of the association, as well as in instances that we're getting into a little bit more in detail, the actual condominium units in which the homeowners live. And then for our townhome or our single family community associations, the association is required sometimes, again, depending on the restrictions, in this case, the exterior portions of the townhome association. In terms of just the specifics, and like I said, we're going to talk about the differences between the townhome and community association. The townhome association, the individual owner owns the actual townhome structure, the building structure, as well as the land underneath it in fee, which means they own it completely. It's not shared by any other individual or the community association. They own and purchase the entire structure as well as the land underneath it. In townhome associations also, the restrictions make or dictate the responsibility for what the owner is supposed to maintain and or insure versus what the association is supposed to maintain and or insure. And typically in townhome associations, when you think about, for example, the picture that you see on the webinar right now, part of that aesthetic is to maintain kind of a uniform aesthetic for our townhome associations. They want the same brick type, the same paint color, the same roof or exterior portion of the townhome to look, again, similar. So when you think about that concept for townhomes and the notion that a lot of our townhomes are typically joined by some type of a party wall, so they're connected in the same sense that you might think of a condominium is connected. The restrictions want the association to try and kind of enforce this uniformity by making the association responsible for certain parts of the exterior. And that way they get to dictate the color, the type. And again, for our townhome associations, there's really no statutory obligation for that exterior maintenance or even the insurance. It's the restrictions that provide for those obligations. Now, jumping into our condominium associations, those are an entirely different form of ownership than single family or townhome associations. The owner, when they purchase a condominium unit, only owns the unit, the airspace between the walls and the things that are located between the walls are owned by the owner. They don't own typically the land underneath. Now, there are always exceptions. There are new forms of condominium ownership that are sprouting up every day, but I'm talking about the general condominium that most of us are going to be working with, being on the boards for, where the unit owner, again, owns the unit only. And then the exterior portions of the unit, and these are really specifically defined within the condominium declaration, what exterior portion of the unit means, including any of the foundation of the condominium building, the walls, the elevators, the stairs, all of those exterior portions, again, are owned in an undivided interest and shared by the other condominium unit owners. So if you have a condominium with 100 units, that one condominium unit owner is going to own the unit and is also going to share and own in an undivided interest the remaining exterior portion of the condominium in a 1/100th, being one of that 100 total unit ownership of the common elements and the exterior portion of the units. Typically, the common elements cannot be separated from that ownership of the unit. And when the unit is transferred, it is transferred with that undivided interest in the common elements. For our condominium associations, there is statutory there is a statutory requirement for insurance obligations, and that's where we're going to get into again a little bit deeper in this webinar. But typically, for any condominium association that was created prior to January 1, 1994, Chapter 81 of the Texas Property Code is going to dictate a lot of what the condominium association can and cannot do. After or on and after January 1, 1994, then we're going to look at Chapter 82 or the Texas Uniform Condominium Act to determine kind of the rights and responsibilities of both the unit owners and the condominium association. As far as, again, we'll talk about this a little bit more, as far as the insurance requirements, Chapter 82 is going to dictate insurance requirements for all condominium associations, but there is a variation depending on what type of actual condominium association you are. For condominium associations, again, I said in 82, the particular section is 82.111. Any condominiums that have buildings with horizontal boundaries, so stacked condominium units, the property code says, to the extent reasonably available, the association must carry property insurance, including all risks of direct physical loss commonly insured against, in an amount which totals at least 80% of either the replacement value or replacement costs or the actual cost value of all the units. So just to be clear, if you are in a condominium unit or you own a unit in a condominium association where there are stacked units, horizontal boundaries, then the association is required to the extent reasonably available, and that's an important term, carry insurance on the units as well. And as I explained, that cost for that insurance premium for coverage on the units is then passed to the condominium association, from the condominium association to the unit owners by virtue of that assessment. It's part of that assessment that condominium owner will pay. So let's get in, now that we understand kind of the differences between the two forms of condominiums, the two forms of community associations that we're talking about for this presentation. Let's dig deeper into the insurance issue. And as I stated, at the beginning of this webinar back in 2022, as we were coming out of the pandemic, we saw these steep increases, and there are a variety of reasons why we saw these steep increases. A lot of what we saw was related to, or the reasons was related to, the frequency and the severity of climate-related claims. And I'll get into a little bit more about those specific types of claims. The fact that we were also headed into a hard market for the insurance industry, and basically that just means that there's a supply and demand issue, that there's a high demand for insurance, but there's low availability for insurance. And quickly, when we're talking about the frequency and severity of claims, we're talking both in Texas and nationally, right? Because we have insurance companies that provide coverage both within the state and nationally, but those both state, local, and national types of claims affected or were a large reason that we saw these steep increases. There were also rate increases that were related to restricting capacity limits. So, we saw steeper increase, but the capacity limits for what the insurance premium or the policy was going to cover, it was decreasing. There were also rate increases because insurance companies, again, as a result of these claims that we had seen kind of creep up in the past few years, were increasing rates because there was a lack of profitability. And there, again, are lots of reasons why these were no longer profitable for our insurance companies. There was also a need for multiple carriers to provide coverage to one community. No longer could you rely on one insurance carrier to provide all the coverage that your community needed. It needed to kind of divide that coverage up. Obviously, inflation, as we're still seeing it go up, was a major reason for why these steep increases occurred. And related to inflation is the increased cost of materials. And then we also saw a few of the insurance carriers actually exiting certain markets, which again these are all interconnected, but that's another reason why there was a supply and demand issue, and why we're in the hard market of having a more increased need for insurance, but a lower supply. In terms of the frequency and the severity of claims, I found a couple of really interesting visual representations of what was happening both in the state of Texas and around the nation. This is from, I believe, climate.gov, but this is a visual representation of the 2021 $1 billion weather and climate related claims or disasters that occurred again nationally. And at the very bottom, if you can see, it says that there were approximately 20 separate $1 billion related weather and climate claims. So pretty big deal. As you can see, based on this representation, there's a lot going on right by and surrounding Texas, which obviously directly impacts us, but again, nationwide, a really big issue for us. And then the next slide, this is for 2022. These are the $1 billion weather and climate related claims. And we actually saw a decrease in the number. We went from 20 in 2021 to 18 separate $1 billion weather and climate disaster related claims. But, I'm not sure that two makes enough of a difference for us, especially as we know, separate from what was happening in terms of climate or weather was the pandemic and claims related to the pandemic. In terms of here locally or in Texas at least, we know that most of our common casualties that we deal with in terms of property related claims have to do with hurricanes and less likely the freeze or a freeze. But unfortunately in 2021, we had to deal with freeze issues. And according to what they're understanding, forecasters are predicting Winter Storm Uri, which is what resulted in the massive freeze destruction in Texas in 2021, is anticipated to be the largest loss in Texas history. The numbers that are coming out are $24 billion and just in costs alone, and then 226 deaths. So pretty surprising, but that was just, again, as recent as 2021. And we know what's going on and around even more recently with this freeze that we saw this year. I don't see this trend changing. So all of these weather-related claims quite literally pushed costs through the roof and made coverage financially unavailable. And unfortunately for Texas, in terms of these claims, obviously windstorm claims like hurricanes are the biggest hazard that we have to deal with typically. But now we're also seeing these kind of unique type weather-related claims like freeze claims that Winter Storm Uri brought to us. So obviously all of these impact coverage, premiums, availability, and it makes going without insurance very, very risky. In terms of nationwide, this is not necessarily weather related, but again, we saw the two maps from 2021 and 2022 that did depict the weather related claims, but we saw the Surfside condominium collapse that also created much more scrutiny by the lenders in the selling process, which meant that people and lenders were looking at making sure condominiums were sufficiently insured and that they were properly funding reserves. And again, nationally, we saw several states, including Florida, place strict requirements on both reserve funding, insurance requirements, and inspections, actually required inspections. So this rising trend in billion-dollar disasters, the fact that the United States is in a hard market where we're seeing this kind of shift in claims as a result, insurance carriers are having to pay out and they're finding themselves less profitable. And the fact that the last soft market where there was enough insurance and profitability hadn't occurred in 2016, seems like we were just headed for the inevitable, which is what we're seeing, these steep increases. In terms of nationwide and beyond, obviously the pandemic, as I stated earlier, was an issue and is still an issue that I don't think we're honestly going to know the full ramification of on insurance companies, on associations, on several different factors or areas of the world and nation and locally. And we're not going to understand the impact necessarily for quite some time, but we do know for a fact that it did impact all areas of our life. And as a result of, again, all of these nationwide and statewide issues, carriers are demanding higher replacement cost valuation limits. They're also attempting to limit the risk through the reinsurance market. So they're trying to kind of shift the risk to a secondary insurance provider. And as I explained, the lower margins on profitability, the carriers kind of reducing their capacity limits is resulting in the need for these higher rates, and also the need for multiple carriers to come in and help sufficiently provide insurance for our community associations. Some of our associations were, I've heard and I've seen, were faced with 300% increase in rates for insurance, which is kind of mind blowing. Often what happens is we don't know that rates for insurance are going to go up until right before we go to renew. And I think that's really just because that's how the insurance market works. Every day things happen that impact rates and policy and coverage. And so often, 30 to 45 days out before it was time to renew, our clients were being hit with these astronomical increases. And as you all know, because that premium or the cost for that premium is eventually passed on to our homeowners by way of assessments, associations were faced with really some challenging questions about whether they could even provide the coverage that either the governing documents required or statutorily they were required to provide for condominium associations. Not only based on kind of affordability, right? Can the homeowners that live in our communities, based on what we know about price point and really the assessments that we charge currently, can they afford to pay more in assessments to cover the cost for these increased costs? Or are we also, another double whammy that came out of this, are we somehow tied in our restrictions, especially for our townhome associations, in how much we can increase our assessments, because maybe we're bound by a 10% limit year over year on how much we can raise assessments without a vote of the membership. And that, again, is dependent on your governing documents. But we did see associations that were seeing a 300% increase on premiums, but they were only able, without a vote at least, to raise their assessments no more than 10% than the year before. So really a big quagmire. The other issue that I think is hard for associations when they're trying to grapple with how to deal with these costs and what the alternatives are, and possibly either going without coverage or less coverage, which again we'll talk about a little bit, is the potential that our board members have, or even our management companies and our managers, for not being able to provide that coverage. And it's not that we're not providing it, but if we are unable to provide it because of these issues, then what type of liability are we facing because of the eventual liability that we might have homeowners that are uncovered when a claim occurs? Um, so a little bit just kind of about the standard of care for community associations. If you're in a townhome association or a single family association, your standard of care is under Chapter 22 of the Business Organizations Code, and that's the standard of care for a nonprofit corporation. As a director, you're supposed to discharge your duties in good faith with ordinary care and in the best interest of the association. And to the extent that you as board members, and then your managing agents, our managers, were trying to find these rates or these alternatives, I think that's really all you can do. I mean, you can't get blood from a turnip, but certainly that doesn't, unfortunately, avoid the potential risk of still being exposed to liability, whether or not there is a substantive basis for a homeowner filing suit against a board member or an association for not living up to that standard of care. But it's in good faith. Have you relied on your professionals in the industry, your managing agents, your insurance carriers, your brokers, your lawyers? Have you relied on all those people, maybe even your CPAs, your accountants, to figure out and come up with the best solution to deal with these issues? That is how you meet that in good faith requirement. With ordinary care is really just kind of what an ordinary person would do in that situation as a director of the association, and in the best interest of the association. What happens if we aren't able to find or provide the coverage, even though we've done our due diligence in trying to find it? Is it in the best interest of the association to potentially go without or go with lower limits, or again, what are those alternatives? Unfortunately for our condominium association, it's a higher standard of care under Chapter 82 if you are an 82 condominium. So this is the one area where my Chapter 82 condominium associations that were developed on or after January 1, 1994, they're subject to this higher standard of care, which is that of a fiduciary, and that's the highest standard. And so again, for those condominium associations, you're looked at with a little bit more scrutiny if you're on the board. And so you're not only are you looking, it's a tough time to be a director, but you're not only looking at what happens if we don't have enough coverage, or we don't have coverage at all because we can't afford it, not only from an exposure to a claim standpoint, a property insurance related claim, but now you're looking at a potential exposure to a directors and officers issue or a liability claim because you weren't able to provide the insurance coverage. And again, I think in my opinion, what we'll see if these claims do crop up as a result of whatever insurance you're able to get or not get, I think the potential for liability is really low as long as you did the exercise as a director to kind of go through and try to get insurance coverage at the rates and the requirements that you're supposed to. But that doesn't stop homeowners from pursuing litigation and again triggering insurance coverage, and again creating a claims history. And so now you're looking at whether property insurance related claims, D&O related claims, and then ultimately what happens is increased premiums, or potentially finding yourself being unable to be covered from an insurance perspective, and it really could spiral downward quickly. And again, I don't want to scare my board members and saying that, if you did your due diligence and you weren't able to find insurance, that you're going to be liable, but it just unfortunately doesn't prevent people from litigating the issue, or at least trying. So let's get to kind of the heart of the presentation, which is what can we do? And I'm sorry if all of y'all have logged in to find the magic golden answer. There's not a lot. I think there are a few options that probably, if you're working with your lawyers and your insurance carriers and your brokers, y'all probably already talked about. But other than some of those issues, you've really got to kind of try your best to provide the coverage that the association needs. In terms of solutions, well, we'll kind of take it one at a time. For my TUCA associations, Texas Uniform Condominium associations, my Chapter 82 associations that and actually Chapter 81, because it's retroactive, that have to cover at least 80% of the replacement costs or the value of the condominium unit if you have horizontal boundaries. Again, not everybody, just my horizontal boundary associations. The property code actually goes through a procedure by which you would notify the homeowners about the association's inability to find insurance coverage, which in my mind, or in a lot of our minds, we thought, great, there's a process by which, if it's not reasonably available as the statute requires, then all we have to do is send notice to our owners and our lien holders according to the statute. Well, one, that's great and all, but that requires time and money and resources, especially in terms of lien holders, to the extent that you have this information, which many times you do and many times you don't. But what happens once you send out this notice? Really, all it does is effectively take away that legal obligation, but it still ultimately leaves you uninsured, right? Or your homeowner's uninsured for that property insurance part of it on their condominium unit. So I'm not sure it's a great answer. Sure, it's a remedy for insurance that's not reasonably available, but there's not really a solution. The other part of that analysis before you send that notice is, what does "to the extent reasonably available" mean? That term is not defined in the property code. Does "to the extent not reasonably available" mean it's too expensive? Or does it mean that it's not available? Does it mean that it's available, but to get to a lower capacity limit or lower coverage amounts? And so, again, while in state law, one of the potential solutions is to say, guys, we've done everything we can from a condominium association insurance standpoint. We've tried to find this coverage for property insurance on our condominium units, and we can't find it. And because the state law says that the solution is to send notice, we've done that, but that still leaves the condominium unit owners exposed to that risk. And so I'm not necessarily sure that that's the best answer, at least for our condominium associations, is to say we don't have it. I did have at least one condominium association that decided to go, and I'll talk a little bit about this because it's related to alternative coverages. They decided to go without windstorm. And in Texas, I think that's extremely risky, right? But let's get into alternative coverages. Whether it's you go with a higher deductible, right? So previously, maybe you've had a $20,000 or $50,000 deductible, and you look at what the premiums are for $100,000 or a $200,000 deductible. You're kind of still taking a chance, right? If you don't have the extra $100,000 or $200,000 on the front end to pay for this increased premium, it's going to be unlikely that you're going to have the $100,000 or $200,000 on the back end if a claim occurs to pay for that deductible. But you're again, this is insurance is risk, and it really just depends. And I don't think anybody has a crystal ball to know whether that's a good risk or not. You just have to take it, especially if you can't afford it. Other possible alternative coverages might be providing for replacement cost coverage instead of actual cash value, right? A replacement cost is a little bit lower than actual cash value coverage. Scheduled versus blanket policies, so that you have a set amount of money for all the buildings, instead of a scheduled, which is a specific amount for each building. And then special versus named perils, right? All of this in terms of what the options are for alternative coverages is another way where you can kind of figure out how the premium can get a little bit lower. It may not get to the point where it still makes sense financially, but again, you're taking a greater risk on the front end, or I guess I'm sorry, on the back end, by saying, look, this is all we can afford, and while it's risky, no one knows if there's going to be a claim, weather related or not, and so we're gonna hope that there's not a claim. So if there is a claim, again, on the back end, if you do have replacement cost coverage versus actual, or you have a higher deductible, then you're looking at a problem at the end of it. But maybe you've had 6 months or so to kind of bulk up some of your funding. I don't know what that looks like for our condominium associations. They're not so tied deeply to some type of a percentage increase, or a lot of them aren't. It's really kind of what the total common expense budget is. And there might even be an opportunity to raise assessments later down the road. But for our single family associations or townhome associations, I know that's very, very difficult. What we saw for a lot of our townhome associations is to amend. There was a question about whether or not they could amend the governing document. So again, if you look back to what the insurance requirements are for townhome associations, it's based largely on what the restrictions say. And so a few of our townhome associations decided, well, we're going to get 50%, a majority, 67% of our homeowners to amend the declaration so that that obligation to provide insurance coverage on the exterior of the townhome is shifted from the association providing that coverage to the individual unit owner, townhome owner. And again, while I think, if you're successful in amending the declaration, which is another hurdle, then what you're doing then is potentially, by putting the burden on the townhome unit owner and shifting that liability, is creating potentially an enforcement issue for the association. After that liability is shifted, again, assuming you're successful in amending your governing documents, of course, the association is going to want to make sure, and other unit owners are going to make sure that those individual unit owners are actually going ahead and getting the coverage, because the association is not providing it. Because it doesn't help you, being a townhome unit owner, if you're covered, but some type of peril or casualty affects the townhome unit that you're either in the same building with or share a party wall with, that isn't covered. So again, on the back end, it creates kind of an enforcement issue. And so, you want to be mindful that, again, you might be saving money in terms of not having to raise assessments and not having to provide that coverage that's required, if you are able to shift that risk. But then you're going to need some money to probably make sure that change in burden is enforced through the association, and that might require litigation, or certainly some type of legal action, if not litigation. Also, kind of a quick comment on shifting that burden for my townhome associations. If you shift the insurance requirement, you also need to probably shift the requirement for the association to maintain those exterior portions of the unit, because those kind of go hand in hand. In my townhome associations, the governing documents say the association typically will maintain the exterior portions of the townhome, including the roof. And that's why we're also providing, the association's also providing the insurance. So make sure if you are working with legal counsel to amend those governing documents, you're also shifting the maintenance requirement for that exterior portion, not just the insurance requirement. And then finally, probably the riskiest alternative or option solution, it's not really a solution, is to go uninsured. And that, has to be probably the worst case scenario. And again, I had at least one client that didn't go without insurance completely, but they did go without windstorm insurance. And no one knows if that's going to be a good bet until this, at least until well past the hurricane season. And we're going to have to all kind of cross our fingers. But again, it's a solution. Whether or not it's a good one, again, is based on your crystal ball, which I know nobody has. But if you're left without any options, if you know that you're faced with a membership, especially in my condo associations, even if you could increase the assessment by $500 or $1,000 just to cover the cost of the premium, not every homeowner is going to be able to pay it. And so you're looking at potentially having a collection issue down the road. And like I said, in my townhome associations, you're looking at an enforcement issue down the road. So I know you're going to say, gosh, Sipra, I was tuning in to get the answer on how to fix this insurance issue. And I wish I had that answer or the secret solution, but I don't. I mean, again, you got to work with your experts to kind of come up with some alternative solutions and do best what is going to work for the association based on where it's located, how many claims it might have, the types of claims that they typically see. So not a lot of good options. I'm sorry to burst everybody's bubbles, but hopefully some options that you can talk through with your brokers and your lawyers and accountants when you're trying to budget for the next coming seasons and renewals. I'm going to say that it's really difficult to predict in terms of what the forecast is, quote unquote, for the next few years, whether we're going to stay in this hard market and we're going to continue seeing these steep increases. My hope, and what I've learned from talking to at least some of the brokers that we deal with, is that this has been kind of an overcorrection as a result of, again, the weather related claims, the severity of them, the pandemic, the condominium collapse, all of these things that have kind of had this accumulated effect on the insurance industry and these premiums. And hopefully we won't see such steep increases. Maybe we'll continue to see increases, but not just so many steep ones. But only time will tell. Unfortunately, this last slide that I have is the 2023 $1 billion weather and climate related claim. And there's not a lot of good news here. And this is through November of 2023, but the number of weather and climate related claims actually has gone up to 25 in 2023. And again, that was through November. So we started with 20 in 21, 18 in 2022, and now we're back up to 25. And, based on how 2024 is going so far in the first 23 days, I'm kind of concerned about the fact that we might not see a reprieve here. Sorry again for more bad news. All right, so hopefully that was helpful for at least some options. I'm going to take a minute now. We've got, I think, at least 15 minutes to go through. I saw some questions rolling in, and so I'm going to go through some of these questions and see if I can answer them for you guys. I hope that was helpful. And again, thank you so much for joining us. We really appreciate it. And I personally kind of nerd out and get excited when I see board members and managers on the call, so many of them, because I know that means that y'all are taking the time to get educated and help our associations kind of stay out of potential liability and exposure to risk. So thank you so much. All right, so let's go into these questions. I think generally, Kyle, correct me if I'm wrong, but I think we can provide the slide decks and for the presentation to any of the people that joined us, and then we'll eventually also either put the webinar on our website and or our YouTube channel, one or the other, but that will be available soon. Any spillover to single home HOAs? The only spillover is really the townhome communities. So that was thunder. So if you're not in a townhome community, I certainly do think, to the extent that the association owns large amenities or reserves, where they also have to provide, obviously, insurance coverage, property insurance coverage on those. They were also seeing increased rates, but just not as much, because it's just I guess less area to cover. But in the townhome community and in the condominium community, we're talking about the actual residence portions, and so a little bit of spillover, but not as much. Which U.S. states does this material pertain to? So the maps that I showed quickly, the climate.gov maps were just climate and weather related claims for the entire US. And it was just kind of a very general visual representation, but there were some specific Texas related ones that you could see. And as I mentioned, obviously we know the hurricanes and at least the freeze that we've been dealing with. All right, for a townhome association with insurance requirements written into their governing documents, are the owners able to amend insurance requirements to reduce the insurance burden on the association and place it on the individual individual owners? Are there any state laws influencing insurance requirements for single family HOAs, townhomes, like 82.11 for condos, or do they come solely from their governing documents? Yes. So hopefully I answered that question, but for single family and townhome associations, there are no statutory requirements currently related to insurance, reserve funding, any of that. What we are seeing nationally is a trend for that to happen. And so I'm not sure really how far Texas is behind on that trend, but we're seeing it right now. There isn't anything for our single family and townhome associations. And so for those associations, again, you look solely to your governing documents to determine what the responsibility for insurance is. Does it typically take insurance company 2 years for increases after major events or named storms? I don't know the answer to that question. I think it's probably quicker than that. There are some companies, although we've been told this shouldn't happen, even when you potentially report a claim, it creates a pending or a threatened claim. It creates kind of a claims history and creates the basis for the carrier to increase rates. Maybe even if it's not an actual claim, it's just threatened. So in my mind, if there's, kind of thinking about in car insurance, right? As soon as you have a wreck, I feel like you see it on your next renewal. So I think it's faster. I think what's happened here again is just several years of big claims where it really impacted what we saw from 2021 to 2022. And 2023 and beyond. And so I don't know that there's a hard and fast rule, but that's a good question, for your broker. if you have a broker, and certainly feel free to reach out to us, and we can put you in contact with some brokers that we use that deal specifically in the HOA industry, that might be able to better answer that question. I've been told that because there are so few insurance companies that provide this specialized insurance, it isn't advantageous to get multiple quotes from different brokers because they're all going to the same small number of underwriters. I've had a very challenging time getting adequate explanations from broker sales staffs to determine what is covered, exclusions, and whether there are even any plausible scenarios that would be covered when it comes to property coverage. We finally concluded that we needed flood insurance to cover any underground utilities such as storm sewers and also concrete that we are responsible for as a gated community. For flood, there seems to be a higher participation of the state in the process, and existing flood maps are not relied upon, and we needed to pay $700 to $1,000 for an elevation survey in order to just get a quote for flood insurance. Is this valid? So, this is one of those where it's kind of really specific as it relates to your association. I think if you're not getting the answers to coverage that you're asking for, then that's a really big problem. It's possible that you need to look into talking to a different broker. Or maybe it might be that you might need to find coverage counsel. So there are lawyers that specialize in reviewing and providing opinions about coverage. And so it might be that you rely on coverage counsel, which I know also costs money. But you, as a board member or as a manager, anyone that's working with associations, you need to be able to answer at least simple coverage questions and what is covered and what isn't. And to the extent that you're not, I think that's a problem. Let's see, what's your experience with insurance premiums for single family associations? So like I said, this part of this presentation is for the townhome associations that are single family, and that's where we're seeing it as it relates to the coverage on the resident or the exterior portion of the residence. I didn't see as much impact. I know there was an impact on my single family associations, just typical single family associations on the insurance rate increases. What do we do if we cannot find insurance coverage? Run. No, it's a good question. I think, there really are only two options. You either go without it, which I think is just extremely risky and not a good idea. And if you're on the board, you're exposing yourself to more liability. There was in 2023, at least I haven't seen it as much in Houston and surrounding counties, but I understand it from one of my partners in Austin. There were amendments made to the FAIR plan that allowed for associations that had been denied coverage. I think it's at least 2 times. So you have to have 2 actual denials to kind of put them in a different pool where insurance would be required. I personally haven't dealt with that issue, so I don't know enough about it to talk to you guys about it. But if you are, if you're interested in learning about the FAIR plan and the recent amendments to it, and you have been denied insurance coverage, then that might be where we go. It really impacts associations that are in areas where there's either low or no funding. So again, I've got to kind of better educate myself on when that is triggered. It might be that historically you're in an area where coverage is typically not available, and it's not applicable to our associations that are just seeing higher increases in rates because of what's going on in the market. So I think that's something that your general counsel could hopefully help walk you through. The 80% insurance requirement, how does the deductible affect that? We have 5%, $1.1 million deductible, which is real problem for roof. Buy down, we can no longer afford another $250,000 to get down to $50K. Again, this is another one that I think is probably best for a broker. The 80% requirement is the bar, right? You have to provide at least 80%. In terms of deductible, I would think that kind of from a ratio standpoint would impact the amount of the deductible that you pay concurrently for a lower for lower coverage. But in terms of exact numbers, I think it's just going to depend on the exact details of your policy. I mean, if you've actually looked at a policy, it's potentially 100 pages long, and there's lots of exclusions and variations in each policy, and it depends on each carrier. It depends on where you're located. So there's not really a kind of a one size fits all answer to that. If townhome risk is shifted to the owners, does that tend to increase or decrease the cost, assuming owners will purchase equivalent coverage? If it's higher, it seems short-sighted to shift this to the owners. Yeah, I hear you. I think I probably left this out of the presentation today, but these homeowners are paying it one way or another, right? It's either by virtue of paying it through the premium that the association's paying it as part of your assessment, or you're having to get it individually and pay out of cost. My understanding is it's theoretically supposed to be cheaper for the association to provide this coverage. And so if it's more expensive from the individual homeowner, I think you'd probably have to drill down on what exactly is covered. It might be that they're getting more coverage, even though it's higher, but it really, again, these are just kind of specific policy questions. But I agree with you. And again, remember, if you shift coverage, you've got an enforcement issue, because you don't know unless you ask for it, and people that aren't willing to provide it, if that mandatory obligation goes to the homeowners, whether someone is actually getting it. And even then, another terrible thing to say, earth shattering. I know it's not. A person can provide you a certificate of insurance today, and the next day, the policy could be canceled for some reason or other for not paying the premium. So what do? Ask for the proof of insurance every day for 365 days a year? That doesn't sound reasonable either. So again, there's risks on all sides of it. Our COA is a different animal. No laws currently in place for detached standalone homes. Any suggestions? Yeah, I'm not sure. There are no laws for single family associations, so it's one of those things that I think you're, again, with legal counsel, brokers, you're relying on your professionals to meet that in good faith element is probably your best bet in terms of trying to get recommendations for your specific community. What about Texas charitable immunity law or statute? Yes, so that's a great question. There are both state and national statutes that protect and prevent, to a certain degree, liability of individuals that are serving on the board from exposure to liability. And this is a presentation or a webinar for another day. We could spend another hour on it or more. There are protections for our volunteer board members and committee members from exposure to liability. And I agree with you. And I do think that generally speaking, if a board member has done everything that he or she can do to try and diligently seek insurance coverage, and depending on what they end up with, they shouldn't have potential liability. And even if they do, the liability would be limited under these volunteer and charitable immunity statutes. I would have a hard time even saying that they would be liable, assuming they met the elements, right? And you weren't completely, grossly negligent in fulfilling that duty. But that's why the due diligence is important. All right, maybe one more question and then we're at 12:30, so I've got to hop off. But again, want to thank you for joining. Our condos are not horizontal, but share walls with neighbors, but we don't own the land beneath us. Can we still amend the governing documents to shift the responsibility to the homeowner? Yeah, I mean the horizontal, the 80% requirement or the minimum requirement under 82111 only applies to units with horizontal boundaries. So if the liability or the insurance obligation is in your governing documents, then yes, I absolutely think you can amend your governing documents. But again, it might be that you amend not only the insurance requirement, but some other maintenance responsibility as well. So make sure you're working with legal counsel on addressing all of those issues. All right, that's all the time we've got. It's after 12:30. Thank you all so much. Again, it makes me happy to see all these names and these people getting educated about how to protect ourselves from potential liability and how to better manage and represent our associations and to serve on those boards. So appreciate everyone's time and happy to answer questions. You can reach out to us if you have any questions, and you guys be careful out there and take care.